Microsoft's AI ambitions are rewriting the playbook for big tech, and its Q2 FY26 results prove it. In this breakdown, we unpack how record earnings, soaring valuations, and an unprecedented wave of AI-driven capital expenditure are transforming Microsoft into a true AI-first giant. For the quarter ended December 31, 2025, the numbers reveal a company reshaping itself, and perhaps the future of the entire tech landscape. Today, we are mapping out the full Q2 performance across four key pillars. First, we'll look at the earnings snapshot and the bottom line. Then, we'll compare the growth of cloud versus the legacy PC business. Third, we dive into the massive AI CapEx and how it's impacting cash flow. Finally, we'll weigh the bull and bear outlook to see if the current valuation holds up. The headline for this quarter is a massive beat and raise driven entirely by cloud demand. Revenue hit $81.3 billion, up 17% year over year. The catalyst here is accelerating AI demand directly scaling Azure utilization. We're also seeing adjusted EPS hit $4.14, and operating income reached $38.3 billion, both up over 20%. Most impressively, management expects operating margins to rise even with aggressive spending. When we look at performance against Wall Street expectations, it was a clean sweep of beats. Total revenue of $81.27 billion was a beat at 17% growth. Adjusted EBITDA of $47.47 billion beat expectations with 23% growth. Non-GAAP EPS of $4.14 also beat the street. The only in-line metric was gross margin at 68%, which saw a tiny 30 basis point dip due to infrastructure costs. AI monetization is no longer a future promise, it is rapidly scaling right now. Azure acceleration is the highlight, with cloud services revenue surging 39%, or 38% in constant currency, fueled by enterprise AI workloads. Meanwhile, Microsoft's 365 Copilot has officially reached 15 million paid enterprise seats. This traction is driving a 17% growth in overall M365 commercial revenue, proving that Copilot is a real growth engine. The revenue mix shows that intelligent cloud is now the dominant force, bringing in $34.1 billion with 29% growth. Productivity and business processes grew 16% to $32.9 billion, propelled by a 19% jump in Dynamics 365. On the flip side, more personal computing declined 3% to $14.3 billion, dragged down by a 9% slump in gaming. Geographically, the business is perfectly balanced, with 51% of revenue from the US and 49% from international markets. Microsoft is showing massive operational leverage to offset its spending. While operating expenses grew by only 5% to $17 billion, operating income surged to $21.8 billion. This means profit is growing much faster than costs. Gross margins held firm at 68%, as Azure efficiency gains are effectively canceling out the high costs of building out AI infrastructure. There is a bit of an illusion in the GAAP numbers this quarter that we need to decode. GAAP net income hit a massive $38.46 billion, but that includes a $7.6 billion non-cash gain from OpenAI's recent recapitalization. This inflated the GAAP EPS to $5.16. When you subtract that $1.02 per share anomaly, you get the true operational non-GAAP EPS of $4.14, which still represents an impressive 24% growth. Building the AI future requires historic levels of capital expenditure. Microsoft spent a record $30 billion this quarter alone on property and equipment to build out AI capacity. This massive build-out temporarily squeezed free cash flow down to $5.88 billion. This is a deliberate strategic bet. Management is trading near-term cash flow for absolute long-term AI dominance, with a run rate now exceeding $50 billion annually. Despite the heavy spending, Microsoft maintains a pristine AAA-rated credit profile. They have massive liquidity with $89.5 billion in cash and short-term investments, against only $40.3 billion in total debt. Because their trailing 12-month EBITDA is over $150 billion, they actually operate with negative net debt. This gives them extreme operational agility to pivot and invest wherever they see growth. Even while pouring billions into AI, Microsoft returned $12.7 billion to shareholders this quarter. This was split between $7.4 billion in share repurchases and $6.8 billion in dividends. Total capital return intensity actually increased by 32% year over year. This represents a combined 2.1% shareholder return yield, balancing aggressive reinvestment with immediate rewards for holders. The risk-reward framework here is fascinating. The bull case assumes AI diffusion continues to accelerate and Azure captures the majority of enterprise LLM workloads, while Copilot drives higher pricing power. The bear case worries that the $50 billion plus CapEx might fail to yield a near-term return, or that regulatory scrutiny in the EU and spiking memory prices could begin to compress those high margins. So how is the market pricing this? Microsoft is trading at a forward PE of roughly 32.5x. While this is in the premium zone, it is fundamentally justified by that 24% operational EPS growth and their leadership in AI. One caveat for investors: free cash flow yield will look optically depressed for a while because of the historic CapEx cycle, even though the underlying business remains robust. To wrap up, there are three core takeaways from Q2. First, AI is delivering real revenue, as seen in the 39% Azure growth and 15 million Copilot users. Second, the CapEx is historic. They're spending $30 billion a quarter to win the AI arms race. Third, their fundamentals are unmatched. A fortress balance sheet and 21% operating income growth allow them to fund this expansion without any strain. The $30 billion question remains: is this massive AI infrastructure investment a generational masterstroke or an overextension of capital? It's the biggest bet in tech history. Drop your thesis in the comments below. If you found this Microsoft earnings deep dive helpful, make sure to like, save, and share this video. Follow and subscribe ZinvestZ for more such smart investing insights. Thanks for watching.